Well, I think we're going to get started, and as people continue to log in, we'll let them join, of course. So official welcomes, everyone. I'm Margaret Chapman. I'm Chief Operating Officer and Partner at Narrative Research here in Halifax. I'm also outgoing Chair of the Board for the Halifax Chamber of Commerce. It's my pleasure to welcome you to today's Navigating COVID-19 webinar with our guests from White LeBlanc Wealth Planners. They're joining us today to cover the market's response to a global pandemic and what it means to investors and their portfolio management team's thoughts on the future. If you have a question during the presentation, we'd like you to type that into the Q&A box. And if you're commenting in the chat box, so there's both the Q&A and there's also the chat box. If you make a comment in the chat box, I'd encourage you to address your message to panelists and all attendees so that everyone who's in this webinar can see the post, because it might be of interest to everyone. You also have the option of just messaging all panelists, and then it just comes to the folks you can see on the screen. So it's your choice, but typically people's comments are things that everybody wants to see. So if you want to send those to everyone, we'll all be able to see that. So I want to welcome our guest speakers and thank them for joining us today. I'll tell you a little bit about the company and then I'll turn it over to them. So White LeBlanc Wealth Planners started right here in Halifax with founding partners Dan LeBlanc and Colin White. The firm has since grown to a partnership team of 5 and a dedicated team of more than 20 working from 5 offices across Canada. The team's practice is unique in many ways. For example, they're one of a small percentage of teams in Canada who are licensed as portfolio managers. This sets them apart from investment advisors and holds them to a higher standard of accountability to clients and oversight within the industry. While the new working reality has not been without challenges, they tell me they're fortunate that because their team has been working collaboratively across the country for some time with systems and tools in place to support that need, that they've adapted well to these changes in their working life. I'm going to turn it over to Dan LeBlanc now to tell you more and to introduce his fellow partners who will be presenting today. So Dan.
Thank you, Margaret, and good afternoon and welcome everybody. As Margaret says, I'm Dan LeBlanc. I'm partner at White LeBlanc Wealth Planners. And with me today are my fellow partners, Colin White, Richard Fuel, and Josh Shellick. They will be presenting today, but before I hand it over to them, I'd like to take a moment just to acknowledge the difficult time we've been experiencing here in Nova Scotia. As an organization, we've been enthusiastic supporters of the Canadian Mental Health Association. We had no idea that this organization would become so much more important to Canada and especially to Nova Scotians in 2020. Just recently, the Colchester chapter of the Canadian Mental Health Association shared with us that they found themselves responding to our community in ways they never anticipated. They are preparing and giving out meals for those who are overwhelmed with the stress. They have delivered groceries and medications, provided treat bags for isolated youth, and virtual meetings and supports are getting busier every day for them. So in light of the heightened need in our province, we've made an additional donation this year to the Colchester chapter so they can continue with their great work. If you're interested in the Canadian Mental Health Association, please visit the Colchester East Hants chapter's website at ceh.cmha.ca. I'd also like to say thanks to you. Many of you have been actively working and running your businesses throughout this pandemic, providing important and valuable services. We know it hasn't been easy. And we appreciate you taking the time to be with us today. We hope you find the information we'll be sharing with you helpful for you and your business as we all move forward in 2020, and hopefully a 2020 that will only get better from here. So with that, I'm gonna close out my video. I will be here in the background and come back at the end of the presentation. For now, I'm gonna hand it over to Josh, Colin, and Richard to take you through the presentation, and we'll see you in a little bit.
Thanks, Dan. So something that we're kind of known for in giving our presentations, and I guess now's as good a time as any to talk about some good news. We're going to pick a couple pieces of good news to highlight that you're not going to see covered in the media all that much. So I want to say thank you to Madagascar, who's celebrating their 60th birthday. It's a hugely biodiverse area of the world. They're celebrating their 60th birthday by planting 60 million trees. So that's fantastic news for a very important area to the global biodiversity. In addition, we have some other more good news, and this is actually a little bit familiar to me because I was a kid, actually, when they were talking about the ozone depletion. And a recent study has concluded that some of the initial ozone damage that had caused some of the initial action in the banning of some chemicals is actually regenerating itself in some way, shape, or form. So again, these two pieces of good news, there's obviously other sides to stories, but these are actual bona fide good pieces of news, and I don't think we get enough of that these days. So there you go, there's some good news. So let's move on to talk about our time today. Perspective. Wow, this is going to be a challenge to get some perspective in these challenging times. It's changing almost hourly with what's going on. But we're going to talk about what's going on compared to previous times in history to see if we can learn anything. Interest rate and Federal Reserve actions, which again is ongoing and in real time. We're going to talk about what we think we know and what we don't know about COVID-19, as well as what we believe about how it's going to impact the market in the short and long term. We're going to have a look at things you should or should not do. The human condition is such that we have a bias to action, so we're going to talk about some steps that we advise you should take and some steps you should probably avoid. And we'll look at some productive ways to spend some of this time that we found that maybe we had that we didn't. Personally, I've invested some time in catching up in the Game of Thrones, which I missed a complete cultural thing for a long period of time, and I've taken this time to catch up with Game of Thrones, but everybody's an individual. So with that, I'm going to pass it over to Josh, and Josh is going to get us underway.
Yeah, thanks, Colin, and thanks again to everybody for joining us today. Really appreciate your time. So just to start, we're going to take a look at what's happening in the market out there. And Colin used the term perspective on the previous slide, and the title of our presentation, Perspective in Extraordinary Times. We need to provide some context for you today. It's, I think, extremely important to provide that context. It's absolutely true, 100%, that we've never seen a global economic shutdown like this in modern times. But if you go back, we have seen pandemics in modern times. We have seen severe economic recessions and big stock market crashes. We've had world wars. We've had massive geopolitical controversies spanning the entire globe. So the word unprecedented and the phrase once in a generation, these are things that we've heard thrown out there multiple times. And for sure, there are some things going on in the world today that are completely unique. But there are also some things that remind us a lot of various times throughout history. And there's a saying that goes, history doesn't repeat, but it rhymes. So what we're looking at is some of the similar times throughout history, and can we draw any conclusions or any insight from these previous times? So just to give you some perspective on the stock markets to begin with, it's been a pretty tough year so far. In February, starting in February, extending through March, we had the quickest 30% sell-off in stock markets around the world in all of recorded history. So the quickest period of time from a market top to 30% drop in the markets that we ever have. It took about 22 days from that February 19th period to see a 30% sell-off. Again, we have never seen that frame of time produce results so bad before in over 100 years of data. So yeah, that's one of those things that for sure is unprecedented. And if you feel like your investment portfolio was just hit by a financial truck, that's exactly why. But you don't have to look too far to find other events similar in comparison. That was the quickest, the most severe drop that we've seen in some time. But this graph here is showing you the path of stock markets, the path of stocks during some other downturns just over the past 30 years. So where these lines end, just if I can explain the graph to you, where these lines end, you can assume that the markets continued higher after that point in time. So the messages that you can take away from this graph here. Well, in 1987, for example, the green line there, we saw that the downturn, the sell-off, was just about as quick as we saw so far this year. There are a wide range of outcomes here. If this is another 1987-like event, we may have already seen the bottom. That's not our base case. We don't know that for sure, but that is a real possibility that we need to consider. It took about 3 months in 1987, and the market chugged higher after that. And we certainly have seen some pretty strong rebounds in markets around the world over the last 6 weeks or so. Believe it or not, technically speaking, we're in a bull market today because markets are up 20% from their bottom. So maybe we have seen the bottom here, and things will continue to improve. Now, on the other hand, you have to the other extreme, you have an event like 2000, where it took not 3 months to reach the bottom, but about 2.5 years of slow, drawn out downturn in stocks before it reached the bottom. And we can't completely ignore that possibility either, because the economy is going to be challenged for a long period of time here. We have never seen in our collective experience in this business anybody that can predict the short term with any reliability. So that's why you're not going to hear us today say for sure that you should be backing up the truck and adding to stocks right now. But you're also not going to have a completely negative picture from us either. Again, it feels like a truly once in a generation event right now. But all of these events that I'm showing you, all these previous stock market crashes were in some way, shape, or form, quote unquote, once in a generation. For example, in 1987, the stock market dropped 20% in just one day. And that has never happened before or since that time. In 2000, markets were at a more extreme valuation than they had ever been, again, anytime before that or anytime since. And in 2008, the entire financial system, the entire banking sector almost collapsed as we know it. So the real message here is that the strength of the global economy overcame every one of these events. The stock market has been a tremendous place to build wealth over long periods of time. And despite all of these events and many others like them, stock markets were at a high in January of this year. So we will get through this. It's just a matter of time, and we're not going to try to predict when. So 2008 is one I mentioned on the previous slide there. It's one we want to dig a little bit deeper on. And Colin, I'm going to ask you this question. What do you see that's similar with 2008 and today, and what do you see that's a little bit different?
Well, thanks, Josh. I mean, one of the things that you saw happen in 2008 was the first time you saw a real true global collaboration from a monetary policy perspective. And we're seeing that happen again today to a very large degree. So, the slide here is talking about, how many billions or trillions of dollars that the various countries are spending. And there's uniformity in the reaction. Everybody's agreed that this is terrible, and everybody's, acting very aggressively to try to overcome things. One of the differences we're facing, though, is that, 2008, we had a financial issue, so we had a financial solution. Now, we don't have necessarily, it's not primarily a financial issue right now. So the fiscal stimulus is a little bit less focused on the actual problem. But, again, everybody's coming to the table. Now, one of my problems is when you see the figure $2 trillion, I mean, once you go past $2 trillion, I run out of fingers and toes. It's difficult to understand exactly, what that means in any kind of context. So we've done a little bit more work to try to make it a bit more real here. Now, these things are moving in real time. Like, there's probably announcements today that have made these slides maybe a little bit less than up to date. But I think the point remains. So we're seeing two main types of fiscal. We're going to bump it into two packages of fiscal stimulus is going on right now. Some of it's, direct spending into things. So there's relief packages. There's money being sent out to individuals, to companies, to different groups. And then there's, there are more loans or the other types of incentives that are being built in the system. And sometimes those are more difficult to quantify, because giving a loan and expecting it to be paid back maybe is not the same as actually spending money in the economy. But again, it's still a stimulus package. So instead of looking at them on this slide in absolute terms, we've expressed it as a percentage of GDP. And GDP stands for gross domestic product. It's basically the sum total of everything a country produces on an annual basis. All right. So what's really relevant to understand is not the absolute dollar value, but how much, similar to your situation, how much of your annual paycheck are you spending? That's what's relevant. So this breaks it into that. So you can see that some of the spending is up, over 30% of GDP, which is more than significant. So on the next slide, Josh, it breaks it down into a little bit more detail. Now, one thing I will point out here The last calculation done by the IMF for Canada indicated that we're looking to run at around a 14 or in excess of 14% of GDP deficit this year. And that is a lot of money for sure. But if you go back in history and take a look at, well, how bad has this ever been? If you go back from 1941 to 43 in Canada, we spent on average we were at a 21% deficit, 21% of GDP for 3 years consecutively during war times, another extreme time in our history. And at that time, our total debt got up close to 100% of GDP, which meant our total debt was equal to the total amount of production that the whole country put out every year. So the follow-up question is, how much of that do we have to pay back? Well, the answer is none. So we hardly paid back a penny of that. In fact, governments in Canada and around the world have consistently run small to moderate sized deficits for a lot of years now. Now, what has happened is that that debt shrinks as a percentage of GDP, which means that as the economies grow, the debt becomes more easier, more manageable because it's a smaller percentage of what's out there. Now, again, this doesn't make it okay. This doesn't make it without risk. I don't want to leave you with the impression that, hey, no, that's fine. We can run all the deficits we want. But there is a historical context we can put this in to say, how might this play out? Now, going into this pandemic, Canada was running about a 50% debt to GDP ratio, approximately. So in that historical context, we have a little bit of dry powder, a little bit of room. So, beyond that, and again, I want to be very careful not to leave the impression that it's all okay. This is still, pretty dangerous times, but there is a history of us having, dug ourselves out of something like this in the past. So if we step on to what's happening and what we know and what we don't know. Now, what we don't know, there's a lot more of that, but let's talk for starters on what we do know. We know COVID is very serious, and we need to take precautions to avoid overloading our healthcare system. My wife is a nurse, so I get updates daily on exactly what's going on with the healthcare system, and these are stressful times for our frontline healthcare workers for sure. We know the unemployment is going to surge, massive, huge, gargantuan. There's going to be a lot of people unemployed in the near term as we come to terms with this. Now, again, there's a lot of numbers are being produced. I think we're only going to truly understand the effect of this 10 years from now when we sit down and study the numbers. But there's a lot of bad numbers coming out on the employment front for sure. We're going to emerge with a different world. We know that. We're not going to go back to the same thing as we used to. I always explain how before 9/11, I used to be able to go through an airport without taking off my shoes. Well, that's a pretty small example, but there's a new normal coming our way, and we don't know what that is, but we do know that we're going to a new normal. Now, we also believe that, and know, in the long term, things are going to get better. As Josh very eloquently pointed out, the globe has seen many firsts in our lifetime. In fact, I probably can count 10 once-in-a-lifetime occurrences in my lifetime, which makes me question the people doing the math. But the globe has always found a way forward, and that we know that the globe will recover from this. The global economy will overcome what we're facing. So what we don't know. So the challenge is that we don't know exactly how far and wide COVID is going to spread, how long it's going to last. There's lots of talk of vaccines. We don't know what the true path of this is going to be. We don't know if our economy is going to emerge from this quickly, or is this going to be 6 months and done? Is this going to be 12 months and done? What is the path of the recovery? Everybody's throwing letters saying, hey, this is going to be a W, U, an L. Those people are being paid by the word. The honest answer is we don't know what the recovery is going to look like, and we're not being paid by the word, so we're not going to use letters like that. Boy, this is something, again, you're reading so much every day, businesses are being impacted. We don't know what the total effect of that's going to be. What will the markets do? Well, no one knows, but we have some thoughts. So first, we're going to talk about market timing, how to do market timing. Not a great plan. And if for those who are gullible, that's me with earlier facial hair than what I have right now. But yeah, probably not. So yeah, market timing, people talk about, hey, is this a good time to put money in? The problem is, in my entire career of almost 30 years now, I've never met anybody who could reliably know the ins and the outs. In order to get the effect of market timing, you have to be able to catch all the top days and miss all the bottom days. And the challenge is those days come right beside each other very often. If you go back a year and a bit from Christmas, we had the biggest one-day loss in the markets for a long period of time on Christmas Eve and on Boxing Day, it all came back. So those moves tend to happen very close to each other. So the possibility of thinking that you can hit one without hitting the other, a little optimistic, I guess, is how we would describe that. So with that, Josh has got a really great point to make with regards to what the difference between the economy and the markets are. There you go, Josh.
Yeah, thanks, Colin. So one of the questions, similar to what Colin was talking about, one of the questions that we're getting today is, why would I put any money in stocks today when the economy is so obviously going to get crushed for the next little while? And Colin talked about the surge in unemployment. We've already seen the numbers surge. Why would I put money into the market when you have 15, 20% unemployment in some of the major developed economies around the world? And the real answer is, the economy and the markets, stock markets, are two different things, and they move differently. Stock markets, they're based on expectations, they're based on emotions, they're based on feelings, and these things are volatile, and therefore the market reflects that. When there's confidence, the stock market will often reflect that ahead of anything happening in the economy. And similarly, when there's negative sentiment out there, even before you see anything show up in the economic numbers, stock markets will often turn lower before that. We saw that earlier this year. In March and February, we didn't have any economic numbers that said that we were going into a recession. We know that now, that we're probably right in the middle of a recession, even though no numbers have come out to report that yet. But the stock market turned down way ahead of any point in time where we would get numbers that reflect that we're in a recession. And we've gone back to 2008, 2009 period of time just to really emphasize this point, because we can see it play itself all the way through. In late 2007, before anything showed up from a negative economic number, the market started turning lower. The recession didn't really hit officially until early 2008. And similarly, on the way back up, the market troughed right in the middle of the recession. So well before it was even thought about that we were coming out of the recession, the market troughed and it started marching higher. If you were waiting, trying to time things, again, like Colin was saying, waiting for negative economic numbers to show up before you sold stocks, well, you would have probably had about 50% down before you actually got out. If, on the other hand, you're waiting for positive economics numbers to show up before you bought stocks, you would have missed 100% upside, literally 100% upside. So that doesn't work either. And I guess, why did the market start turning higher before the recession ended? Well, it's because people looked around and said, okay, we know that there's an end coming to this. We've seen things get really bad. People started turning more optimistic and said, I can see the light at the end of the tunnel. I can see things improving. The market is a forward-looking instrument. It's going to sense those things coming, sense those improvements coming, and reflect that in the price. So I guess in the short term, volatility could remain huge, but we really shouldn't be looking for any economic numbers one way or the other to tell us when is a good time to buy. Now, fortunately, you don't need to be all in or all out of the market. And here's where diversification really comes into play. We are big proponents of diversification. You haven't heard us speak before, but if you ever talk to us on a regular basis, you'll hear us regularly emphasize the need for diversification, whether it's diversification by asset class, by geography, by style, by individual company. This graph here really shows you how diversification works and why it can be important depending on what you're looking to get out of your investment portfolio. From January to March this year, here's the returns of several different asset classes. So if you're invested in government bonds, you're feeling great right now because government bonds were actually up through this period, January to March, when stock markets around the world got killed. Corporate bonds did okay as well. On the other hand, you have something like Canadian stocks, where you saw a lot of pain. And not only was that because it's stocks, and stocks tend to be more volatile, but we've also seen a lot of pain in the energy space as well. Oil prices going negative, and that has a big impact on the Canadian stock market, with a big part of our economy being a part of that sector. So on the stock side, if you just diversified a little bit to international ideas, either outside of North America or in the US, you fared a lot better. And then if you're willing to step outside of just stock investments and look at some bonds as well, you fared better still. If you were looking at the market a year ago and said, why would I invest in a government bond that pays me only 2% a year? This is exactly why. So not all asset classes are affected evenly. Not all sectors are affected evenly by economic downturns. And concentration in any one asset class or sector or industry is going to skew your performance one way or the other. So, and we can emphasize this idea by looking at a few specific industries, because like I said before, the Canadian market was hit particularly hard, but which parts of the market were hit hard as well. This graph here shows you the path of several different investments or industries over the course of 2020 up until a couple of weeks ago. So the red line there, it represents US stocks, the S&P 500. So it's been down, obviously, but there are some specific industries that have fared a lot worse. Banks, for example. A lot of people in Canada especially think of banks as, well, this is sort of a staple of my portfolio. I can always go here and get decent performance. But actually, they've underperformed this year on concerns about some of the debt, the real estate that they have out there. Energy, I mentioned a couple slides ago. Obviously, with oil prices in the tank going negative, it's tough for the energy industry to perform well. And if you want to be even a little bit more specific, we've cherry-picked the hospitality industry here, hotels, resorts, and cruise lines, and seen them. They're down more than 50% this year. So you could invest in U.S. stocks in general, remain diversified. It was not a great year. But if you had picked one of these other industries and put a significant chunk of your portfolio into them, then you'd be feeling a lot more pain than your average investor right now. So again, just speaking to the benefit of being diversified, and don't get married to an idea. Because if you're too married to an idea, if you have too many eggs in one basket, that has potential to have some pretty catastrophic events play out for your portfolio. And that's exactly what we saw for the hospitality businesses this year. Looking great going into the year. Everybody's traveling more. Economy's doing well. Everybody's keen to travel and spend money. And all of a sudden, the Crown Princess, or whatever it was called, the cruise line, is reported as its own country when it comes to a number of COVID cases. So needless to say, not a good outcome there. The next question we often get, and Colin, I'm going to toss this one back to you, is now a good time to invest? What do you think?
Well, thanks, Josh. And to kind of marry to the last slide is, where should I invest now? So if you accept the fact that being selective in where you invested and planning on the boomers, taking a lot more cruises, and hospitality was the sector you had to invest in, and how that has played out for people who bought into that thesis, we're going to caution against trying to pick the sector this time, because it comes with the same level of risk. But the other thing that as with all important questions, the answers are nuanced. So, to invest money now expecting a quick turnaround, especially now, again, we did this presentation up a few weeks ago and it's even moved since then. But to expect a time like this and say, I got money I'm not using for 6 months, what can I do with it? The answer is nothing. That's not what you should be expecting here, because again, there's still a lot of volatility out there, and you've got to be careful about those things. So our answer actually hasn't changed. If you came to us and said, when's a good time to invest? I said, well, you should keep your long-term and money invested long-term, and you should keep your short-term and money invested short-term. And what short-term and long-term investments look like depend on where you are, age-wise, and a few other factors to go with that. But this market shock does not change that. So if you've got money you're not going to use for 5 or 10 years or longer, that's long-term money. And this event will be a nice blip on the screen, 5 or 10 years from now. but it shouldn't change your allocation to your long-term investing. Now, one thing Josh pointed out during one of our presentations I thought was very good was that, let's say you were sitting in cash, because you were expecting a global pandemic or expecting an event of some description. That's great. You got lucky. Congratulations. Very, very happy for you. And the only way to be lucky is to have the courage right now to make the allocation. And sometimes courage can be an awful short supply when things like this are going on, because there's a lot to be afraid of and there's a lot of bad news that's out there. So we're going to go through and talk about things that we think you should not do. All right. So this is going to be a very specific list and address some very specific issues. So don't make long-term decisions based on rare and unpredictable events. So, if you're saying that's it, I'll never be fooled by another global pandemic again, that's probably not the way to respond to this, right? It's a terrible event. It's a black swan event. But, to draw the plan up for the next 10 years because you're going to be disappointed, there's going to be another once-in-a-lifetime event happen in the next 10 years. That's going to catch you flat-footed. So don't get too detailed about saying, I'll never be caught flat-footed by a global pandemic again. Now, don't assume that your goals have remained unchanged or unaffected, but also don't assume that they have. So, it's a worthwhile time to sit down and take a look at your goals, your expectations, and what this does to your plan. This may have changed things, or it may not, but it's worth asking the question. So don't necessarily assume either way when it comes to your goals and expectations. But don't expect things to return to normal quickly. Now, again, some of the countries that have released and relaxed restrictions are now finding the need to put them back on. There's a lot of uncertainty as to what the new normal is going to be like and when we're going to get there. So don't expect that, by the end of the summer, this will be all fine. We'll be back to doing what we were doing before, because, again, we don't think that that's a reasonable expectation, and you should avoid that. So what can you do? Let's talk about the big green check mark, because green check marks are better than big red X's. So you can take a look at your current spending. So this is, my 18-year-old daughter and I have had many long philosophical conversations. That's what you do with 18-year-old daughters. As this is a bit of a reset. This is disrupting whatever pattern you had. So this disrupted the way you were spending money. Now, if you're fortunate enough to still have an income coming in, your expenses are now up for discussion amongst your own self. You can sit there and consider, hey, was I happy with how things are doing? Do I want to come up with a new pattern? Is there something I want to consider doing? Give some thought to your planned purchases and expenditures. Again, you have a chance here. This is a reset. This is a do-over. You can change your priorities on these things, and you may find you're feeling different about certain things, and you can adjust your spending patterns. Seek professional advice, and this is a shameless self-plug. You knew it was coming eventually. Some professional advice about opportunities specific to your situation. The most difficult thing is perspective, and as we talked about at the start of this presentation, perspective is important. And one thing that a professional advisor can bring to the table is that perspective, because we've worked with hundreds of people. We've gone through hundreds of retirements. So we've seen a lot of things, and we've learned a couple of things along the way. Sometimes we can help with, bringing perspective to that conversation. So it may cause you to reassess your plan and your goals with current conditions in mind. What we mean by that is if you were thinking that, my portfolio will give me exactly 6% rate of return every year, and that will be enough for me to get retired. Well, maybe you should reassess that, because again, these kind of events are going to reoccur. When asked to describe about portfolio management, we often will say that we build boats, we don't predict the weather, because again, you don't know what's going to happen next. All you can control is the quality of what you put together. The follow-up expression that I'll steal from one of our other providers was that the worst time to try to fix a boat is in the middle of a hurricane. So this might not be the best time to radically overhaul what you're doing. It might be, but it also might not be. So it's a good time to consider if there's any activities that are warranted. So what can you expect from your portfolio? Now I'm going to give a long-ranging answer on this, and all of these are nuanced and could go into their own slide presentations, but just to kind of give you the range of answers. As discretionary managers, we've been actively changing the asset allocation in our client portfolios as the events have unfolded. We've been fairly active in doing so. If you're invested in mutual funds, the individual mutual fund managers all have a prospectus or a mandate that they are fulfilling, and many of them will tell you it's been the most active time for them in their careers for allocating cash and repositioning portfolios. So you should expect that if you've got a mutual fund manager, that they're making changes within their portfolios to take advantage of what's going on. Because again, I will guarantee you, nobody saw a global pandemic coming, and that does change the investment, time horizon and expectations for sure. So there should be changes being made. There's some exchange traded funds that would also have that underlying trading going on. Others are just index exposure. So if you've got something that's just index exposure, then you have the market. But if you've got something that's a bit more thoughtful, then again, you would expect that that exchange traded fund would have the same underlying alterations in the portfolio. But one thing that you should expect from your portfolio at all times is communication from whoever's managing your money. Because again, times like this, there's lots of questions, and whoever you've entrusted to manage your portfolio should be available to you, should be communicating with you. You deserve that, you should expect that. And I think it's vital to get through times like this and in the best possible shape. So I'm going to pass it over to Richard. He's going to give you the one key thing that every small business owner has to do in order to survive this pandemic, because he's really smart. Richard, what's the one thing they need to do?
I got a couple of things, Colin. Thank you. Thanks everybody for listening in. I know a lot of you listening today are business owners, and it has been a pretty challenging couple of months. I'm a business owner myself, and some of the businesses that I'm involved in have been impacted by COVID. In fact, one of the businesses I'm involved with was also impacted by the crane collapse. So 2 mandatory shutdowns in the space of 6 months. I certainly wasn't expecting that, and I'd like to think I've always been attentive to risk. I spent a number of years in corporate banking, and as an investment manager, I've spent the last 20 years working through events such as the dot-com technology bust, 9/11, and the financial crisis of 2008, 2009. But I don't know if anything could have prepared me for the last 6 months. It has been an exhausting and challenging time. And after a pretty good run economically since the financial crisis, with rising markets, falling interest rates, and credit spreads narrowing, coordinated global economic growth, we've learned that risk still exists, and now it's reared its ugly head. So the current situation has reinforced for me some practices that I think we as business owners should follow as best we can to protect the business, but also to protect our personal assets, our personal net worth. So I'd like to share some of those thoughts with you today. The first thing that I think is important to talk about is that it's always important as a business owner to maintain liquidity and access to capital. The crisis has shown that a business can find itself in an unexpected cash crunch at any time. So ideally, a business should maintain access to additional funding, and the owners should have the ability to inject additional capital if needed. So I would say this would warrant that as business owners, we should hold at least some of our non-business assets in vehicles that are easily convertible to cash and not at distressed prices. And I think another point is to maintain a good relationship with your bankers, with your funders. You need to turn to them at times like this. So in good times, give them the financials that they need for review in a timely manner. Keep good financial records, have a good external accountant, and get your year-end work done as quickly as possible. Don't wait that 6-month period that you're allowed by CRA, etc. Challenging times such as these present opportunities for financially sound companies. I remember back in 08-09, there were around 7,000 banks in the US, and today there's less than 4,000. That's a result of the weaker ones going under or getting taken over. And it's expected that coming out of the COVID crisis, there'll be even less banks. Similar thing is happening in the energy industry. I'm also a licensed business broker, and I work with buyers and sellers of small and medium-sized businesses. And I see today unfortunately, many businesses in financial distress. And for stronger players, that can present an opportunity to grow by acquisition. But it does require a strong financial position and access to capital in what's a challenging time. The second point to talk about is don't ignore your non-business assets as a business owner. I know your business is your focus. Many of our clients' businesses can represent over 50% of their net worth. However, often most of the value of the business is in goodwill, which is probably the riskiest asset in terms of sensitivity to market conditions. So your non-business assets may be very important too. And we believe business owners should manage their non-business assets in a manner that reflects their unique situation. As I mentioned earlier, as owners, we may need to tap personal assets at any time to provide capital to our businesses. Therefore, a mix of high-quality publicly traded securities or funds and possibly real estate with not too high a loan-to-value ratio seem like good starting points. I think it's also worth considering if you have potential liability as a shareholder or as a director, and if you need to consider protecting your personal assets through the use of trusts or by investing in assets that provide some measure of creditor protection. And also, I think business owners should look at their overall tax picture regarding their business assets and their personal assets. For example, owners should generally try and get as much assets as possible into registered retirement vehicles, whether it's using RRSPs or possibly individual pension plans. The COVID-19 crisis has shown that unexpected things can happen to your business, but it also can happen to you as an owner. And so as owners, we should have in place a contingency plan and an estate plan in the event something happens, whether we pass away suddenly or become incapacitated. This is a complex area for discussion, so just some basics to consider. Have a valid power of attorney for financial and business assets that can kick in the event you become incapacitated. A valid and appropriate will is vital to protect the business assets in the event of death. For example, an executor of an estate is obligated to wind up a business in a timely manner if the owner dies, unless a will specifically states otherwise. So it is important as a business owner to have an updated and valid will that reflects your wishes. If there's multiple owners, if you have partners in your business, a shareholders agreement can guard against disputes and provide for funds to deal with the deceased partner's share. And also adequate key man insurance can provide capital to a business in the event of an owner's death, to provide operating funds or to pay out the deceased estate. Finally, business owners probably more than anyone should do some financial planning for retirement that looks at how their business assets and their personal assets can meet their retirement goals. Some of the more common questions that we work on with business owners are things like, will I have enough money to retire on? What actions can I start taking today to improve my financial future? Am I being realistic about what I can net after tax from the sale of my business, etc.? It is possible to take an inventory and an estimated value of your business and personal assets today and make some projections of what after-tax net worth will be at retirement and what level of retirement income you can enjoy. It takes some effort, but the exercise can often uncover strategies that can make significant improvements in your financial position and also your retirement outlook. So hopefully some of those thoughts, will tweak some things for you. And at this point, I'll turn it back to Colin and Josh. Thank you.
Yeah, sure. Thanks, Rich. So one of the things that you may find on your hands these days is some time. And Colin is spending his time watching Game of Thrones and catching up on all that. I'm still not sure if he's got to the end of season 1, but lots of activities still to happen for him. I'm excited for him to experience everything. I've been spending a little bit more time reading, catching up on some reading that I've deferred, but maybe you want to put some time to some more productive uses and look at your financial situation. So there's a few things that you can do, and one of the things that we want you to try to avoid is spending time on things that you can't control. You can't control when the market's going to rebound. You can't control when COVID restrictions are going to be lifted, but there are some other things that are entirely within your control that can help your financial situation. So when this, this whole period is over, you're ready to hit the ground running. Richard mentioned estate planning a little bit. It's not just important for business owners, it's important for all of us to make sure you have a good handle on your estate plan. You've been at home with your spouses and kids for 8 weeks now. You may have rethought your will in some way, shape, or form. On a more serious note, maybe you have a marriage or a separation, or have had another child over the last several years since your will was last updated, and it's time to pull that out of the closet, probably buried somewhere under all your other stuff, dust it off and review it. It's important to review your will every time you have some type of life event. You also may be at home contemplating your mortality at this point, and I think now is a great time to take a look at your insurance policies. Again, pull it out of the closet, pull it out of the dustbin, wherever it is, and review it all. Insurance, it can be a little bit daunting for people. Feel free to reach out to us. We're happy to help. We're happy to review your insurance policies for you, understand your situation, and tell you if you have too much or too little insurance, because it's not just a foregone conclusion that you don't have enough insurance. Maybe you have too much insurance and you can revisit some of that, save yourself a couple bucks every month instead of paying for those insurance premiums. Very important. It's a great time to sit down now and look at your expenses. How have you been spending money? And not just over the past couple months, because I'm sure all of our spending habits have changed. I'm not going to restaurants and bars as much. Maybe you're spending a little bit too much time doing online shopping. I don't know. But you want to look at what's your normal spending patterns, because at its core, your financial plan is really based off of your spending and your savings. Take the last 6 months of your spending and try to average and categorize it on a month-by-month basis. A lot of the online tools now from online banking platforms will make that very easy for you. It's a lot easier than it used to be. You no longer have to be going through statements and totaling it up by hand. And of course, if you have an advisor, time to book some meetings with them to go through all of these questions in more detail. We make it sound pretty simple, but it's not. It's not simple. It's not easy. So lean on those professionals in your life. Lean on those people that you trust to help you answer some of the tough questions that you have going on in your life right now. So with that, I just want to wrap up, and we're going to get to some Q&A here for sure. I just want to say thanks again for spending a bit of time in your afternoon with us today. We really welcome the opportunity to present to you, to present our point of view. And if you're looking for just a second opinion, a little bit of information on any aspect of your financial life, feel free to reach out to us. We're open. All of our staff are working hard from one location or another. And we've got this technology thing pretty well figured out now. So we're happy to do a video meeting with you. Everybody stay in place and stay safe and still get the advice that you're looking for.
All right. So Margaret here, and I really want to thank you guys for all of those insights and all those tips, really great things that we could all be doing right now. So I want to open it up to all the attendees and ask if you have any questions, any specific things you're dying to get clarification on or wondering about your own situation with your business or personally. And you can type those into the Q&A, or you can also put them into the chat. just while people may be thinking about what questions they have, I just wanted to clarify,